What's up everyone, it's Kadi with MoneyVest. So in today's video, we are going to be talking about S&P Global, ticker symbol SPGI. This is a company, a stock that we've talked about on the channel before. It's a very, very high quality business. I do love SPGI a lot because, like I said, fundamentals are very strong. We're going to be using our very own MoneyVest platform to analyze this company and give you guys a bit of an update on where we are with this business. As always, if you enjoyed this video and find it helpful, make sure that you drop a like and don't forget to subscribe to the channel. If you're just joining us for the first time, and link to our Discord and Patreon is going to be down below if you're interested in joining us for our MoneyVest beta launch. We're going to be launching our platform on July 8th, 2024 for all the beta members, and you're going to have early access to this entire platform using our financial models and calculators to look at a lot of other MoneyVest metrics, including for calculating fair values, intrinsic values. So right now there's a 51% discount with a special price that you can lock this price in and of course have early access. So link's going to be down below with limited spots left. And again, if you have any questions, please feel free to reach out. So first things first, let's talk a little bit about where we are. SPGI is near all-time highs at just over $446. You can see this is the monthly chart and how well the company has done since 2008. The stock price is up almost 3,500% with a very nice consistent uptrend of higher highs and higher lows. So it actually boasts a very strong economic moat, making a durable business that will likely steadily compound over time because the S&P Global and Moody's have a duopoly in the credit rating industry and they control about 80% of the entire market. Furthermore, if you take a look at S&P Global is a high quality company with a well-diversified business model. It encompasses ratings, market intelligence, data analytics, indexes, ESG assessments, commodity and energy transition, and other workflow solutions to help companies and governments make more intelligent decisions as well. And again, it trades at a bit of a premium valuation relative to its peers because of the high quality business fundamentals that it has in its companies. So S&P Global is a well-diversified financial company with a strong market positioning and a wide moat business model. Growth headwinds have impacted the company, but it is expected to see improvements in fiscal year 2024 as well. So if you come over to SPGI, let's see what kind of M score this company has. I'm assuming well over 3.5. It's 3.11. So that's probably is going to be my guess is based off of valuation, which maybe is going to be a little bit lower. In other words, it's driving the M score lower because valuation is going to be a bit higher. So if you come over to some of the numbers here, so in terms of growth for the business, you'll notice a 3-year revenue growth of about 18.86%. 5-year, it's grown by over 14%, and 10 years, the revenues have grown at over 10%, with diluted earnings per share last 3 years coming down 5%. Diluted earnings per share 5-year up 1.27%, and 10-year, it is only up 5.3%. On a 10-year basis. Free cash flows on a 10-year basis have increased 23%, 5-year 12.8%, 3-year very, very low, and then shares outstanding are up 9.6% on a 3-year basis, 4.7% on a 5-year basis, and 1.3% on a 10-year basis. Expected EPS growth over the next year at 12.28% for the business as well. Valuation, like I said, is a bit premium at almost 11 times sales, almost 50 times price earnings here on a trailing basis. And we got free cash flows, price of free cash flow trading at over 35 times for the company as well. So a little bit more on the higher side when it comes to the valuation. But let's come over to our MoneyVest metrics. So what we're going to do is we're going to analyze for the last 7 years. And we've got growth across the board, scores of 3.61 out of 5. Revenue here increasing steadily. If you come down, plot for gross profit, operating income, net income, operating cash flow, free cash flow, everything seems to be moving in the right direction for SPGI. So again, gross profit also increasing, but they have seen some headwinds with regards to operating income. It's been more or less stable at around $4.6 billion. It kind of peaked in 2023, which is good, 4.6 billion, but they did decline in 2022 relative to 2021. And this right here is going to be some of their operating cash flow, free cash flow, and net income, which again declined in 2022, then re-accelerated back in 2023. However, net income has not yet recovered from their 2022 highs of well over $3.2 billion. So that is something to keep in mind. And shares outstanding have also increased. In other words, they did dilute in 2022. So that's could be one of the reasons why the stock price didn't really move much in 2022. So it kind of sold off quite aggressively and then really hasn't really traded back up to all-time highs in a very long time. So you can see the Significant decline in 2021 all the way to 2022, lows of 41%. And it's still below its all-time highs from about 3 years ago, still down 5.3%, still yet to recover. So that's something. And then if you come over to margins, that's one thing to keep in mind is the margins are compressing. In fact, they're worsening for the company here. As you can see, the gross margins come down from 72% to now sitting sub 70. We've got the operating margins that are now sitting at around 36%. That is lower than 42% from back in 2017 and significantly lower than the 2021 highs of 54%. And free cash flow margins also coming down from about 43% down to now sitting at 28.5%. So that's a pretty significant decline here. And finally, net margins coming down from 36% down to 21%. So that again, they're worsening across the board when it comes to these margins. Other than that, it seems like return on assets, return on equity, return on invested capital, and return on capital employed, those margins continue to be very, very strong. So if I remove for all of this, you'll notice that we did see a pretty significant decline in return on equity. But everything else looks like they are coming down. It does seem to say that we are seeing in 2023, everything did decline compared to what we have seen before for the company. But compared to the average of 14.8, again, 2023 numbers coming down quite aggressively. So let's just go over to the last 7 years again. Yeah, so we've seen decline in efficiency as well for the business. So 4.33 and around 8.4 and 8.37% for when it comes to efficiency here for S&P Global. Now coming down to some of the balance sheet items, so cash improving, but debt is improving at a much faster rate. So again, if you take a look, you'll notice that cash is or was more in 2021, but then of course decline in 2022 and 2023, and then a sudden increase in overall debt levels from of course 2021 to now sitting well over $11.4 billion for the company as well. And then finally, if you come down to the valuation, it trades at a premium to very expensive valuations for S&P Global. So coming over to fundamental analysis, if you plot for the last 16 quarters for, again, revenue, gross profit, operating income, and net income as well, and let's just do for shares outstanding as well over here, you'll notice the revenue is increasing, so that's good. But again, they've struggled a little bit with margins, especially if you consider the last 3 years, but mostly in the recent quarter-wise, they're starting to accelerate once again to the upside. But operating income-wise, it's been more or less stable, and now we're looking at $1.5 billion in the most recent quarter for the company, which again is lower compared to the same time last year. But again, quarter over quarter, some reasonable growth here for the company. Net income also increasing year over year and quarter over quarter, but still yet to recover from where we were back in 2022 as well in that quarter. And shares outstanding, more or less stable over the last about 8 quarters, I should say. But they have increased quite a bit from 2021. So from about 242 million to 339 million, and since they've just been buying back some of those shares. And as a result, it's been coming down. If you come over to cash flows, and finally, if you plot for free cash flows over here for the business for the last 12 quarters, again, it's been more or less unstable, but $924 million in March 30th quarter here. It's slightly down from 1.3 billion in December quarter for the company. So quarter over quarter, slight decline for the company. So when it comes to analyst estimates, we got a strong buy rating, 17 ratings here, with a high target of 565, a low target of 404, and an average price target of $502 per share for the business, with a CAGR, 5-year CAGR of just over 21, almost 22% for the company, with a revenue CAGR of just over 7%. And finally, if I come over to the balance sheet, I really am curious to see where their cash and their total debt is sitting at. So long-term debt is going to be over here. We're looking at, again, more long-term debt of $11.4 billion compared to cash of $1.5 billion for the company. Long-term investments are also there of about $1.775. So I guess you could say that they're sitting on almost $3 billion, a little over $3 billion in cash and long-term investments, but debt levels are very, very high at over $11.4 billion for the company. For software, for a more market intelligence and data analytics company, that seems to be very, very high for this business. So when it comes to forecasting for the long term, if you were to use the earnings from 2023 of 2.6 billion, and if you forecast for 5 years, the last 5 years of growth here has only been 6% for S&P Global. If you are being optimistic, analysts are pricing in for about a 20% growth rate. If you come over to ratios, what you'll notice is that the company is trading at a 31 times forward price to earnings multiple, trailing at just under 50. So that again is, I would say, a little bit more on the expensive side when its own 5-year average is closer to 24. So that's what we're going to use. We're going to come over to our analyzer, discounted earnings model, 5-year analysis. We're going to simply plot for 25 times earnings multiple with a growth rate of, let's just do 18, because analysts are pricing it for 20%. They're usually very optimistic when they're forecasting for the future. 18% compounded annual growth rate, but I do believe the company is not going to be diluting shareholders as much as what they've done in the past 5 years, because we did see a small spike in 2022 to 2023, and then of course, or sorry, 2021 to 2022, and then of course last couple of years they've been more or less stable. So let's just do a share dilution of 1.5%. And if we hit calculate now, we're looking at a significant overvaluation here for the company, primarily due to the price to earnings multiple and of course the growth rate. So market's pricing in for 20%, and right now at 35 times P multiple, hit calculate, and now we're 22% overvalued at $346 being the fair value. But at the same time, again, those are very high expectations for a price to earnings multiple to be 35 and a growth rate of 20% over the long term. It's possible. However, margins have been declining. Efficiency-wise, they're not really doing super well. And as a result, it's kind of a long shot if you're expecting a 20% CAGR and a 35 times P multiple. So I would be a lot more comfortable at max 25 times P multiple. And even if I do growth rate of about 20%, we're looking at least a 247, 250 in terms of that intrinsic value. And this is going to be that sensitivity grid where you'll notice the 25 times earnings multiple with a 20% growth rate. And based on your expectations and your analysis of different inputs, the fair value would obviously change for the stock as well. So that's going to be the analysis on S&P Global. It is a company which is very solid. I mean, it's got great use case, lots of potential, but the fundamentals have certainly been coming down a little bit more recently, especially when it comes to profitability and again, net income. If you take a look at the last 12 quarters, it's been a little bit more inconsistent, definitely sold off in 2022. And as a result, the price, of course, got reflected. The stock price reflected the fundamentals. And then since then, we've just been consolidating sideways. Gross profit is starting to pick back up, but net income is yet to rebound fully. It is going higher, but it's still yet to rebound fully. So for those reasons, I think the valuations is still a little too much for this company, especially for my liking. And for that reason, this right here at close to sub $300 would be a very strong support to watch for S&P Global. So if you come over to the daily chart, this right here is going to be the entire sort of analysis. We've got some inverted head and shoulders, and we got a breakout. And right now we've got a huge resistance sitting right over here for the company with a reasonable support sitting right over here at close to $405 per share for this stock. I'm going to clean up the chart a little bit, and we're going to remove some of these lines, but $405, very strong support down at 338, down at 300, and of course sub $300 also to keep in mind. But this is a company that again trades at a pretty expensive valuation in my opinion. So if you come over to statistics, again 50 times earnings, almost 11 times sales. So if you're comfortable paying that, be my guest. So hope you all enjoyed this video, found it helpful. If you did, make sure that you drop a like, and don't forget to subscribe to the channel if you're just joining us for the first time. And again, links to our Discord and Patreon is going to be down below if you want to access this entire platform and of course do your full fundamental comprehensive analysis on on the platform, and of course get a better idea, better sense of how the company is doing, how individual stocks are doing. Link's going to be down below, and we'd love to have you on board with a 50% discount right now that we're offering for early access and of course for the beta members. So as always, happy investing. I'll see you all in the next video.